Short exercise 5-4. We're going to journalize merchandise sales transactions. So it says journalize the following sales transactions by Paul Sportswear. So we're doing the accounting for Paul Sportswear. Explanations are not required. So we're going to, on August 1st, we're going to sell some women's sportswear on account. And then later we're going to return some of those because they're damaged. So we'll have to lower the customer's accounts receivable. And then finally, the customer is going to pay us on the 10th, less the return and less the discount. So let's get to August 1st. Paul sold $66,000 of women's sportswear on account. Credit terms 210, net 30. Cost of goods sold is $33,000. So we're going to sell some women's sportswear that costs us $33,000, and we're going to sell it for $66,000. That's 100% markup. I like this business. Begin by preparing the entry to journalize the sale portion of the transaction. Do not record the expense related to the sale. We will do that in the following steps. So remember, any time we're selling inventory, we're going to have two transactions. The first transaction shows the sales revenue, and the second transaction will show the cost of goods sold and the inventory. So August 1st, Paul sold $66,000 of women's sportswear on account. So since we're selling this on account, are we getting cash? No. Instead of cash, we're going to get accounts receivable, which is an asset. So is this asset going up or down? It's going up. So we're going to debit accounts receivable. AR going up by $66,000. Now we need a credit for $66,000. And do we have a sale? Yes, we do. Sale is a revenue. So looking over here at the revenues, do we have more revenue or less revenue? We have more revenue, therefore we're going to credit sales revenue. Well done. Now journalize the expense related to the August 1st sale. Cost of goods is $33,000. So we have to update our inventory and we have to update our cost of goods, also called cost of goods sold. So cost of goods sold, do you remember what type of an account that is? That is an expense. So remember, cost of goods sold is an expense. A lot of students forget that COGS, cost of goods sold, is an expense. So do we have, since we sold this inventory, do we have more expense or less expense? We have more expense, so we're going to debit COGS for $33,000. And our $33,000 credit is going to be our inventory going which way? Remember, inventory is an asset. So once we sell this inventory, do we have more inventory or less inventory? We have less. So inventory is going to be credited. So really what's going on, whenever you have inventory, when you buy the inventory, it's an asset. A lot of people think, well, if I'm going to sell it eventually, isn't that an expense? No, it's not an expense until you sell it. So when we first buy some inventory, we record it as an asset. So its assets are going up. And then when we sell that inventory, the inventory goes down. So basically we're transferring the asset from an asset to an expense called cost of goods sold. So our inventory never becomes an expense until we sell it. And that expense is called cost of goods sold. Excellent. All right. August 5th, Paul received a $5,000 sales return on damaged goods from the customer. Cost of goods damaged is $2,500. So they're going to return some sportswear that cost us $2,500 on that we were going to charge them $5,000. So the easiest way to do a sales return, now a sales return means we are doing the selling. That does not mean that we bought it and we're returning it to our supplier. So the definition of a sales return is we sold it and our customer is returning it to us. So the best way to do a sales return, the best and easiest way to think about is we're just going to reverse the sale. So the accounts are going to be reversed. But instead of lowering sales revenue directly, we're going to keep track of the returns with an account called Sales, Returns, and Allowance. Now, some of you might be saying, well, do we really need to keep track of sales returns? So my best example of why a company would want to keep track of sales returns instead of just lowering sales directly is when I was a college student, one of my fellow students would go to Costco and buy a computer. Costco had a generous return policy of 1 year. If you return that computer within 1 year, they would refund your money, no questions asked. So this student would go buy a Costco computer, return it a year later, get his money back in full, and then turn around and buy a brand new computer, which would be faster because that's how computers are developed. Each year they get faster. And so with the result being each year he would get a free upgrade for a computer. So what Costco did is they kept track of their sales returns and they noticed that their computers were being returned a lot. So what they did is they modified their return policy and said you can only return it within 3 months. So that cut down Costco's returning, or the customers returning their computers quite drastically. So that's why a company would want to keep track of sales returns. All right. So again, when our customer returns some of our sportswear, we're just going to reverse this transaction, but instead of reversing sales revenue directly, we're going to use an account called Sales, Returns, and Allowance. So here is our expanded accounting equation, but this time notice I have some contra accounts down here. We got contra assets, which is accumulated depreciation. We don't have to worry about that for this problem. But here's our contra revenue accounts, showing you the pluses and minuses. So remember, up here, revenues increase on the right side. A contra revenue means it lowers revenues. So its pluses and minuses are opposite. So when we record more sales returns, we are going to debit sales returns and allowances. And same way when we have a sales discount, the sales discount is going to increase on the left side. But right now we're only dealing with sales returns and allowances. So let's get back to our journal. And so we know we're going to have to debit sales returns and allowance. Now, how much were we going to charge them for what they return? $5,000. So let's go back up here to the original sale. So when we have a return, we're going to reverse, pretty much, we're just going to reverse this transaction, these two transactions. So this first transaction, the amounts are what we're charging our customer. The second transaction is how much did that inventory cost us. So when we do the return, the first one is going to include numbers that we're charging the customer. So we were going to charge them $5,000. So that's why we're using the $5,000 and not the $2,500. So let's go back up here. So what happens to accounts receivable when the customer returns it? We have to lower accounts receivable. Here we increased it with a $66,000 debit. So now we have to decrease AR. So that customer owes us $5,000 less now. So again, we're just reversing these two transactions with the exception, instead of lowering or reversing sales revenue directly, we're going to use sales, returns, and allowance. And also notice it says, do not update the merchandise inventory with this entry. We will do that in the following step. So now we get to update our inventory. It says now prepare the entry to update the inventory account for the cost of the returned merchandise. Cost of goods returned, $2,500. So again, going back up here, this is when we originally sold it, we lowered inventory. So we're just going to reverse these two accounts. So instead of inventory going down, inventory is going to go up. So inventory going up, cost of goods sold going down. And the amount is $2,500. So again, we're just reversing the second entry of the sale. We're reversing it for the amount that the items cost us. Now, it's August 10th. Paul, that's us, we received payment from the customer on the amount due minus the return and minus the discount. So here's the way I like to logic our way through this. Let's find out how much the customer owes us. So the customer originally owed us $66,000. So let's see if we ever lowered accounts receivable. And then, let's see if I can get these both on the screen at the same time. So accounts receivable is increasing $66,000. And then with the return, we lowered their AR down here, $5,000. So how much do they owe us after the return? Well, they owe us $66,000 minus the $5,000. So they owe us $61,000. So when they pay us off, we have to get rid of this AR from our books. So the way we get rid of the AR is we need to lower it, which means we're going to credit the asset. So I'm going to skip a couple lines. We'll find out why later. So we have to get rid of their debt to us. In other words, our accounts receivable. We're losing that asset because they're going to pay us cash, $61,000. Now, let's calculate how much they're going to pay us. Why do we need a calculator? Because, don't forget, they bought it on credit terms of 2/10 net 30. That means if they pay within 10 days of August 1st, which they are doing because they're paying us on August 10th. So they paid us within 10 days. So since they're paying us within 10 days of the date of the invoice, they're going to save 2%. So we're going to plug in the 61,000 times 2%, which is 0.02, equals 1,220, 1,220. This is the amount that they save. Now, the way that when we're doing the selling and we offer a discount, we want to keep track of that. So that's called sales discounts. So you might be asking, well, why are we debiting that? Well, let's go back over here to our contra revenues. Contra revenues are down here. So do we now have to record more sales discounts or less? We have to record more sales discounts. So that is why it's a debit. And now we just need to figure out, well, how much are they going to pay us in cash? The way we do that is we take 61,000, subtract the 1,220. 61,000 minus 1,220 equals 59,780. So another reason you knew that this sales discount had to be a debit is because debits, which are these two numbers, must equal credits. So if you had put the sales discount over here, this transaction would not have balanced. So that's another reason why we had to put the sales discount as a debit. Check our answer, and there we go. That's it.